Recessions can be scary. Markets fall. News sounds gloomy. People panic. But for investors who understand what's happening, recessions can also be a massive opportunity, if you know what to look for. Let's break it down. What recessions really are, what happens during one, and how you can actually profit from the downturn. First, what is a recession? A recession is when the economy slows down for a significant period, usually defined as 2 consecutive quarters of negative GDP growth. Businesses make less money, unemployment rises, consumer spending drops, and stock markets usually take a hit. But here's the thing, recessions are normal. They're part of the economic cycle. On average, they happen every 6 to 10 years, and most last less than a year. The good news? Every recession in history has been followed by a recovery. And some of the biggest gains come right after a crash, but only for those who stay invested or jump in smartly. What happens to markets during a recession? During recessions, stock prices usually drop sharply. Volatility increases. Markets swing wildly up and down. Fear and negative sentiment dominate the news. Some sectors, like tech or luxury, get hit harder, but others, like healthcare or consumer staples, often hold up better. This is where smart investing comes in. Because when great companies are on sale, it's a chance to buy quality at a discount. Tips for investing during a recession. Here are some key strategies to help you invest wisely during tough times. 1. Don't panic. Stick to the plan. Selling during a crash locks in losses. History shows that those who stay invested recover and profit the most. If your timeline is long-term, short-term drops shouldn't scare you. 2. Look for value in recessions. Even strong companies may see their stock prices drop. That's your opportunity. Look for companies with strong cash flow, low debt, good leadership, and essential products or services. You're buying them at a discount, and when recovery hits, they're usually the first to rebound. 3. Focus on defensive sectors. Some sectors are more recession-proof. Healthcare. People still need medicine. Utilities. Everyone uses electricity and water. Consumer staples, things like food, hygiene, and cleaning products. These sectors tend to be more stable during downturns. 4. Use dollar cost averaging. Instead of trying to time the bottom, invest steadily over time. That way, you're buying at different price points, averaging out your cost and reducing risk. 5. Consider dividend stocks or ETFs. Even during downturns, some companies continue paying dividends. These can give you steady income while you wait for prices to rebound. You can also reinvest those dividends to grow your position. 6. Keep cash on hand, but not too much. Having some cash means you can take advantage of drops. But don't sit on the sidelines forever. Markets recover faster than most people expect. Real-life example, 2008 and 2020. During the 2008 financial crisis, the S&P 500 dropped over 50%. But those who stayed invested saw huge returns as markets recovered. Same with 2020, COVID caused a sharp crash. But the market fully recovered in under 6 months and hit new highs a year later. Final thoughts. Recessions aren't fun, but they don't have to destroy your financial future. In fact, they can be the best time to build long-term wealth. Stay calm, stick to a plan, invest consistently, and look for opportunity in the chaos. Thanks for watching. If you found this video helpful, click like, subscribe, and check out our other videos to become a smarter investor. And remember, this is for learning purposes only, not financial advice.